So you found the deal, it's below market, the renovations numbers make sense, but there's one problem. The bank needs 30 to 45 days. And in this market, that deal will be gone in five. So today we're solving a real investor problem. How new and experienced fix and flip investors and BRRR style investors secure short-term project-based funding quickly without putting themselves in a dangerous position. So this is not about gambling. This is about strategy. LeAnn Lyon is back and she works in the private lending space and she helps investors across short-term access short-term capital for renovation projects that traditional lenders often won't move fast enough on. And she structures funding for fix and flips and those BRRR deals where timing, leverage, and exit strategy matter. And today we're breaking down how fast funding actually works and how to use it intelligently. So, LeAnn, welcome back.
Thank you. I'll make it easier for you because we're going to say that a lot. We just say burr.
I was going to say it, but I'm like, what does that mean? Yeah, BRRR.
Absolutely. Yeah, we'll get into that for sure. But it's basically buy, rehab, rent, refinance, and then repeat.
Okay. So, before we get further into that, I do appreciate you clarifying that though, because I did read it as burr, and I'm like, I don't know what that means. I wonder if the audience does. Um, but often people complain about the banks being slow. And so, what are these deep issues that fib and flip investors run into?
Yeah, it certainly has happened where I've gotten a call where they say, "Oh, my financing didn't go through suddenly." And it usually happens, unfortunately, right at the last moment because an assessment gets done on the property and then they find out there's a bigger issue that they didn't foresee. And so then the underwriters are like, nope, because banks don't really want to own real estate. It's really not what they want to do. But if there's a problem with it, and you can't get it fixed in enough time or you default on the loan, guess who owns the property? It's the lender. And
Right,
so a very specific buy box that they want to go in. They're set up for low risk and for occupancy, whereas what I work with are often those issues where maybe the house has been abandoned for a while. Very few banks want to take that on. In fact,
right,
we
right.
buy from banks in those situations.
Okay, so why don't traditional lenders like distressed or heavy rehab properties?
Uh, Basically, because there tends to be a lot more issues, and there's certain
Right.
types of mortgages. And again, mortgages are for residential owners. They're going to live in the property. There's certain types of mortgages, like a VA loan, for instance, that they won't even let somebody move into that property if there's certain issues. For instance, maybe a bathroom is not working or the kitchen isn't functional. In that case, they really don't want to touch those, but they're perfect for a fix and flipper.
Mm. So what does underwriting look like on these projects?
Well, banks underwrite mainly the borrower. They're looking for the W-2 income, the tax returns, the credit score, the clean property, like we've been talking about. But
Yeah.
private and hard money lenders tend to look more at the deal, the purchase
Mm.
price, the rehab budget, the after this. For me, this is all the sexy stuff, right? The after repair value, the exit strategy. That's a big one, where banks will say, does this borrower fit our box? Private lenders ask, does this deal make sense? And can this investor execute that deal?
Right. And so how often does speed determine whether an investor wins or loses a deal?
So often because
Okay.
frankly, sellers want to sell.
Yeah.
Sellers want to sell. And so if you're able to come in to an offer and one person says, "Yeah, I have to go through my bank and we'll get it done in a couple months," and somebody else says, "Hey, I can have this deal done in a couple weeks potentially," which one is the seller going to be most attracted to? Of course, it's always situational, but that's often, it just means the difference between getting the deal or not getting the deal and getting going on it. At certain times of
Right.
the year, getting the deal and getting done with the fix and flip means getting on the market when the market is hot versus when the market might be cooling down, say after school starts.
Right. Yeah. So what happens financially when an investor misses a closing window?
Well, they really lose the entire profit spread between their purchase price and the after repair value. Another investor can step in with faster funding and capture that upside. And their contractors, if the investor has contractors, they're just kind of sitting around waiting for the next job. And they don't sit around. They can move on. So they might
Right.
lose the time, the capacity that they could have to have more profitable project. And missing a lot of windows can ultimately interfere with the trust factor that people have with you.
Yeah, for sure. Oh my gosh, isn't that the case? So is it fair to say that short-term investing requires short-term capital?
Yeah, yeah. Fix and flips and BRRR projects, like we've talked about, BRRR, BRRR, projects. They tend to be short-term, high urgency strategies. They're trying to use the slower, more rigid, long-term capital for a fast project creates that friction. Who needs more friction in our lives right now? And
Nobody.
short-term investing, right? I'm actually in a season right now of reducing my digital friction. And it's so freeing when you can reduce friction. I'm just loving it so much. But short-term investing works best when funding that really matches the speed, the timeline, and the risk profile as well.
Mm. So let's clarify some of the language that we're using just in case the audience doesn't quite understand what this means. So, what is short-term project-based funding in simple terms?
Yeah, well, let me break that down. It's money specifically for a project, like a FIP, a FIP. How about a fix and flip or a rehab,
Hey, that's just like a
rather
burr.
than yeah, it's a FIP. No, rather than a 30-year home loan. It's very different. Typically, it's short term. When we're talking about hard money, it's almost always short term, 6 to 12 months. And often it's interest only during the rehab part, and then it's a big payment at the end to pay back the loan that was secured in the beginning. When they go to the point of either selling or refinancing, that's the exit strategy. So it's secured by the property. Like I said, instead of the person, it's more about the property, and it's designed to get you in, get you through the renovation and out. So the focus is really, can this deal work and be paid off or refinanced on a clear, understood timeline by all parties?
Got it. Okay. So, is this hard money, private money, bridge lending, or is it something else?
So private money is kind of a little bit overarching. It incorporates many things. Hard money is, like I said, the more short term. It's the faster stuff. And so there's people who specialize in the hard money lending. And I work with many lenders that really that's what they do. Then I have other lenders who really want to do the longer term. They want to help finance the Airbnb or the long-term rental or the Section 8 housing, those types of things. So that can include private money can include both.
Okay. So, how is it structured differently than conventional financing?
Well, conventional loans, most people are more familiar with conventional loans because that's what you get when you get your mortgage. And they're
Hmm.
long they're amateurizing, which means that from the beginning, you're paying interest and principal. And in the beginning, you're paying very little principal and a lot of interest. And then when you get towards the end, it speeds up and you're paying a lot of principal and a little interest. And that's designed for primary or long-term holds, which again, I can help do those for the properties that as long as the owner is not living in them, they are a business purpose property, we can do those types of things as well and amortize it. But
Right.
short-term projects funding is usually interest only, like I said, with the balloon payment in the end.
So is the fast funding pretty much always high interest then?
It often is a little bit higher. Sometimes it's not. It really depends on the appetite of the lender. It depends on so many things, really. The time of year, the amount of availability of properties. It depends on the borrower's experience. How much experience do they have? How involved are they going to be? There's so many things that can change that. So rates and points in general may be a little higher than traditional mortgages. And that's the trade-off, though, for speed and the flexibility. The real question is the total deal profit. What do I net after the financing costs? Because if the higher cost loan allows you to do a more profitable deal that you would otherwise miss because you didn't have the speed, it can be so smart to take advantage of it anyway.
Right. So then how should investors evaluate the cost versus speed and opportunity?
Well, it's exactly like that. Investors should really compare the cost of the capital versus the missed profit and all the
Mhm.
relationships that you may have with the looking at your contractors and looking at, what you've got going. I mean, if you lose out on this property, investors are kind of fun because they're not as tied up. Like when I looked for my first house, we looked at 70 houses, no joke.
Wow.
We wanted to find, I know, our poor realtor. We did use the realtor who endured through that, the horror stories in real estate of the realtor who does that, and then they're like, I just decided to get my own license, and I'll just buy the house. And I mean, that
Oh my
happens
God.
too in real estate, in residential real estate. But we looked at 70 houses because we wanted to find the perfect house that was in the right neighborhood, near the right stores, had the right parks, had the right, everything situational. Where investors, they're more about the plan.
Mm,
What can I get in? When can I get out? It's about the exit strategy, and it's far less about all those nitty-gritty details. So they really
right,
want to jump in. And if this one doesn't work out, they just go find the next one.
right. Yeah. So in terms of timelines and flippers, so where do timelines usually get miscalculated?
Well, a lot of places actually. There can be, a lot of fix and flippers, especially when they're new. They think, oh, I'm going to buy it on this date, and the contractor is going to show up that afternoon, and they're going to do all the things, and it's going to go. They said it'll take 5 days. Well, it might even take four, and, or whatever the case is. So they don't take into account things are going to happen. If you've ever watched a TV show about flipping houses, there's usually something behind a wall
Mhm.
you have to
Yeah.
accommodate for. So if you don't, take all those things into consideration, that's one of them. But also not leaving room for permits, for inspections, for supply delays, for getting the extra time, for listing, for selling, for closing on the back end of it, and not accounting for the lender's process, the appraisals, the title, the draw inspections. There's a lot of ways that this can go sideways that people don't expect initially.
Okay. So let's talk about who this is for and who it's not for. And so who would be an ideal fit for fast funding?
It's really an important distinction right there. Investors that are really set for this ideal fit are investors, and I almost want to put this in quotes, doing business purpose flips or BRRRR projects on non-owner occupied properties. Business
Okay.
purpose, non-owner occupied, super important. And people who understand or at least are actively learning their numbers, their purchase number, their rehab number, their ARV, their uh, after repair value, timeline, everything. And investors who need to move quickly and are prepared to treat it, most importantly, really like a business. They're coachable, they're open to feedback, and they respond quickly to what's needed.
So do beginners qualify or should this be reserved for those experienced investors?
It really can be for anyone, and even beginners, they do qualify. And again, this is the beauty of working with a broker because I can find the lender that's willing to invest in a beginner. But beginners
Right.
often do need to have a good mentor, a contractor, an agent, somebody that they're learning from, and I can help you figure that out. I can help you find that person, that experience. Experience definitely helps, but attitude is everything. Honesty, preparedness, willingness to learn.
Yeah. So then what makes a borrower strong?
Well, really, again, the clear, realistic numbers, knowing that, a believable exit strategy. If somebody comes to me and they say, "Oh, can you finance this 100%? I'm going to buy it for 400 and I can sell it for 450." That's not realistic at all. There's no profit hardly in there. You'd think, well, there's 50,000. No, there's not, because when you sell it, you're going to have to sell it probably with a real estate agent. You don't
Right.
have to. Many do, and that will eat up a lot of your equity. So, also having a track record of a strong team. Do they know people, or can I introduce them to people so they develop that strong team?
Right. So how important are numbers like the renovation budget, the exit strategy, and ARV? And can you tell us what ARV stands for?
After repair value.
Okay.
So, after repair value, renovation budget, exit strategy, they're all super critical. The whole loan hinges on those three pieces. A good investor can explain ARV, rehab budget, and exit plan in very plain language so that the lender knows exactly what they're getting into so that they can make an offer that will probably get underwritten, that will probably be approved. They've stress tested the numbers instead of being like, in the best case scenario, like we just talked about, right? And
Yeah.
they can really walk through their deal and explain it well.
Okay. So what tells you that someone understands the deal?
Basically, having those numbers, if
Yeah.
they can explain those things to me, then I can, probably give them a stamp of, okay, I'm ready to take this over to the lenders and see who's willing to take a risk on you. Because it's a lot of
Right.
money we're asking for sometimes.
Yeah, for sure. So now let's talk about the other side. Who is not appropriate for the fast funding?
Yeah, there are people, like I said, if they're coming in and saying, "Can you give me 100%?" Probably not. No, there are
Yeah.
certain situations and there are some opportunities. I'm willing to talk to people like that, but it's not going to come from one lender. Unless they're
Right.
your brother, maybe. And I wouldn't recommend that either. Um, yeah, or people, like I said, wanting to live in the property as a primary home. Nope. Borrowers who are chasing the fantasies of no money down, like I've mentioned. Anyone who resists sharing documents. If I say, "What's your credit score?" I want an answer, not a, "Well, what do you need that?" Because, I can't work with that because I have to have this information. So red flags would be unrealistic, the ARVs, like I've mentioned as well, tiny rehab budgets. Oh, I can get this done in $5,000. It's a kitchen. No, you can't.
Yeah.
Or ignoring reality, not having an exit plan. Oh, and then I'll just figure out what I'm going to do. Nope, because you're going to pay interest only every month until you figure it out. So nobody's going to give you that money in the first place.
Right, right. So let's now talk about the BRRRR strategy and short-term capital. So let's talk BRRRR investors. Where does short-term funding fit into the buy, renovate, rent, refinance, repeat strategy?
So, short-term funding is the beginning part of it. It's often for the buy and the rehab phases. So, we've got bridge loans, we've got fix and flip loans. They're similar, but not the same. But they do allow usually for somebody to purchase the property. The fix and flip also oftentimes can include the money that the investor needs to fix up the property. And so both pieces can be part of it, with the right lender. Once the rehab is done and the property is then rented and stabilized, then investors move on to the longer term debt like a DSCR.
So why is timing so critical in that model?
Well, fast capital helps to recycle money. The
Mhm.
faster it gets done, again, with a person who says they want to do a fix and flip, but they want to take a year to do it, they're going to be paying, let's say it's a $2,000 a month is the interest. Every single month that goes by and progress isn't made on that property, they're actually losing $2,000 out of their eventual profit or more, depending on, if now they hit the market at a bad time and they have to take a hit there as well. So
Mhm.
investors really want to pull their cash out and back out and refinances as soon as possible, as soon as the property can be stabilized.
So what happens if the refinance appraisal comes back lower than is expected?
That can happen in those situations. And again, this is where it takes a really wise and stable investor because they may not be able to pay off the entire short-term loan with the refi proceeds. It can happen. There's a turn in the market, or it turns out that whatever you've done with the home ends up not being something people are wanting. They might have to leave more cash in the deal or bring in additional funds. And it can really, of course, strain their cash flow and delay their ability to get out and get on to their next project, I should say project, same idea. And this
Mm.
is why conservative ARV estimates and stress testing numbers are so important.
So then how should investors stress test their numbers before borrowing?
Numbers, numbers, numbers. Did I mention I have a math education major? So run scenarios with the lower ARVs, higher rehab costs, or slightly longer timelines, and still ask yourself, can this still work if I'm off by 10 or 15%? And make sure that DSCR, which is the longer term loan, or cash flow, still works at a more conservative number for rent. So if you get to that point, you're going to hold it, you're going to rent it, you're going to refinance it. Are you still going to be able to make income on that, even if the rent rates go down? And rents go up and rents go down. So you have to look at the long term there as well.
Right. So I would like to talk about structure and risk management now. So fast funding often gets the risky reputation, right? Like it's super risky. So how do you protect both the investor and the lender?
Well, this is where I see people really either stay safe or get into a lot of trouble. um, by making sure my job is to make sure that the deal, the terms, the expectations, they're aligned and communicated to both sides. I ask the hard questions up front about timelines and budgets and exit plans and make sure that's really clear. I help to match the deals and the lenders who have the appetite to fit that type of project and borrower and encourage clear communication and communication from the beginning all the way through the end.
And then, so what does proper vetting look like?
Vetting includes reviewing those numbers, their experience, their team, the property details, the location, of course, right? And
Mm.
yeah, there's just clarity in terms of the interest rate, the points, the rehab draws, the extensions. Can they pay it off in advance? Are there any penalties to paying early? Because even people who buy and hold, which is kind of a longer term strategy, let's say in 3 or 4 years you want to dump the property. Well, if
Mm.
there's a hold and you can't for 5 years, you're going to end up paying money to get rid of the property if you need to at some point. So you need to know all those things up front, so at least you know. And everybody should understand what happens if before they sign.
Okay. So it's not really about speed. I mean, it's fast, but it's a controlled pace.
It is. I mean, speed is the speed part is usually in getting the offer. When somebody finds a great deal, there might be five or six other people looking at that great deal at the same time. So
Sure.
being, essentially pre-approved and talking with me even before you have a property in mind means that we can start looking at your experience, your credit, the things that still do count. Lenders still want to know, are you a good person? Are they going to invest in you? Even though we don't pull W-2s and tax information, at least not all the time.
Got it. So if someone is listening and they want to flip or BRR using short-term funding, BRRR using short-term funding, what are the first three things that they should prepare?
Let's see. I would say, start looking around, get to know what the area is, clarify their strategy, understand the difference between fix and flip, bridge loan, understand where you want to go with the BRRR process. Gather your basic numbers, a target, price range, rehab, uh, what the expected ARV is in the market. And number three, start building your team. And if you don't have one, again, start talking to people who can help build your team. Go to real estate investor associations or talk to me.
Right. And so what documentation needs approval or speeds approval, sorry, in the whole process?
Purchase price, rehab estimate, projected ARV, and a realistic timeline.
Mhm.
We can't say this enough. Basic LLC information is going to be needed. So just have this stuff available. The faster you can supply this, know what your credit is, be aware of your credit, and know of your existing properties and loans. Keep this stuff handy because if it's ready to go when you're ready to go or when that right property shows up, we can move fast if you can move fast.
Right. And so let's talk about what you do. So tell us more about what you do. And when someone contacts you, what happens first?
Well, first step is usually like what we're having today. It's a conversation, usually on
Yeah.
Zoom to understand, their goals, their experience, their deal. I get to listen to their dreams. Where do you want to go with this? And, if they are saying, yeah, I want to live in the house for a year and renovate it, I'll be like, that's great. Let me introduce you to a mortgage professional, right? Or
Yeah.
gently correct them and help them see what real estate investing really can be and how it really can fit into their dreams. There's also some strategies that I know that many people have never heard of as ways to get into real estate investing that you just never hear about out in the world. They're perfectly great strategies. How about being an investor that never has to fix a toilet or fix a roof? There's a way to do that.
Amazing. And so tell us more about where people can find you and find more information about you or to contact you.
Yeah, basically the easiest thing is go to my website, come on over to lioncapitalllc.com, and that is where you can get to my website. You can find out more about me. You can read through lots of frequently asked questions. You can review other podcasts that I'm part of, as well as jump on my calendar and let's just have a conversation.
Amazing. Thank you so much for being here today and for talking about all this stuff and for answering all of my questions. There was a whole list of them.
It's a fascinating topic, and thank you for having me here today. It was really fun.
It was so much fun. So, fast funding isn't about cutting corners, it's about matching the right capital to the right strategy. So, for fix and flip investors and BRRRR operators, understanding short term project based money can dramatically increase momentum when used correctly. We'll include LeAnn's information in the show notes for anyone who wants to explore whether this strategy fits their investment goals. Because in real estate, the difference between sitting on the sidelines and scaling is often speed backed by that structure. LeAnn, thank you again. And thank you to our audience for tuning in. I genuinely look forward to the next episode. Until next time. Bye, everyone.